Hi, I'm Mark Wells, the owner and founder of Preferred Financial Services. We're a mortgage brokerage company in Greenville, South Carolina, and my son Hunter is here with me. We wanted to introduce ourselves to you. This is our first video. We had a complete video we did yesterday that ended up with no sound on it, so we're back under better technical circumstances and hope that you enjoy the video. We started the company in 1989. We've been doing mortgage loans for homeowners and for home buyers for over 35 years. And we're here to just familiarize you with what a mortgage broker does, how the mortgage process works, and introduce you to terms and definitions and ideas that will help you in your own home financing efforts.
As he introduced me, my name is Hunter Wells. I'm Mark's son and the new generation stepping into the business. I have a Bachelor's of Science from North Greenville University, but decided to step into the business as the opportunity allowed me to. And one of the main things that I would like to talk to today is just explaining more so what the broker platform is, your first steps into home ownership, kind of what to expect, what to look out for, what to be prepared for. But one of the bigger questions of the matter is, what is a broker? Because I feel like a lot of people hear that word a lot, but they don't necessarily understand what it entails.
I've always found that the easiest explanation is to understand it in terms of what you've probably already encountered, and that is an insurance broker. An insurance broker operates a company under which he's able to write policies under multiple different insurance companies, whereas a captive insurance agent, like a State Farm agent, can only offer you State Farm products, and a nationwide insurance agent can only offer you nationwide products. An independent insurance company could offer you not only those two companies' policies, but many others. And a mortgage broker is really very much the same thing. We have within our portfolio 20 to 25 different lenders that we can place your loan with, and we use the multiple sources to solve multiple different issues that arise in the mortgage process. One of the main reasons for having multiple lenders is that every day each one of those companies' managers wakes up and they've got to decide what their rates are going to be that day. And as in any market situation where there are people competing for business, someone quotes a lower rate than someone else. So we keep multiple lenders so that we can get the best rate that's available in the market. The other reason is that lenders have certain sensitivities from time to time. There are many lenders that are very appraisal centered, and their biggest issues that arise in underwriting have to do with appraisal type issues. And if we have a difficult property that's going to be difficult to appraise, we just don't put that lender in our mix. We go to someone who is more likely to accept a quirk in an appraisal or something that's slightly outside of the boundaries of what would normally be seen. So for all of those reasons, we have the advantage of having multiple sources. Also, we often have a situation where one lender turns down a loan and we flip it to another lender and they make it, and you say, well, how can that be? And the answer to that is that the guidelines and regulations for, say, a conventional loan are over 1,700 pages. And of all of those regulations, everything is not black and white. There are a lot of things that are open to not only an interpretation of the rules, but what we call offsetting factors, and that is you might have a borrower that doesn't quite meet a criteria, but if they have other strengths, the underwriter can consider those other strengths in approving the loan and overcome the regulation that might be clouding the issue. So for all those reasons, we think it's great to have a broker platform, have multiple sources. We're competitive with rates, but we also can get the loans done.
And one of the advantages of a broker platform is the fact that we legally represent the borrower. We don't have any skin in the game. We're not lending our own money, so we can speak and protect you as the borrower in your loan transaction. Like he mentioned, there are pinches along the way with any lender that you go with, and instead of you tackling all of those questions and all of those concerns alone, we are backed up with 35 years of experience in this field, and we're more of a relational business here, meaning that we will answer any questions that you may have, and we will fight to get you the loan. Again, we're not lending our own money, so we don't examine everything with the emotional kind of connection that a lender kind of has to look at the loan with, because they are taking a risk themselves. For us on a broker platform, we are more just speaking for you and legally representing you as the client.
And I've always said that when you go to a lender, underneath everything that's being done, there's the inherent question that the lender has, and that question is, why should we not make your loan? In other words, they're looking at you through a lens of a risk assessment, and they have to ask that question. It is their money. They are at risk. And so they have to approach you as their customer from the standpoint of, why should we not do this? A broker kind of turns that completely around in a different manner. And because we're not at risk in the loan process itself, our inherent question when you come in to buy a house is not, why should we not do this? But our question is, how do we get this done? It's not that we're free from the regulations. We still have to conform to those regulations. But as I mentioned, there are often vast differences in the interpretations of some things. There are a lot of gray areas. And so when we hit a snag in a loan, we don't throw in the towel and say, well, we're not going to make this because we hit the snag. What we say again at that point is, okay, we've got this issue to deal with. How do we offset this problem? How do we reposition this borrower to where the loan can be made? So we are effectively, as Hunter said, your advocate into a system that is often opaque to the borrower, and something that we've learned over the years we've been doing, how to best interpret all of the gray areas and navigate those for you.
Yeah, so now that we've kind of covered what the broker platform offers to a borrower, I would like to talk just about, the first home buyers program, stuff like that, or if you're buying your second, third home, it doesn't matter, but what to you is the most important thing when beginning the process, whether you're fresh out of college and looking for a house, or you have your stable job and you're just looking to move? What do you think boils down to the most important part?
It usually comes down to credit, and that can be a matter of, do you have established credit, or it can be, do you have established credit, but have you been accessing and using credit in the right way, resulting in a good credit score. Your credit score is both a threshold that you have to get over in order to even be considered as a home buyer. And generally that score threshold starts with FHA loans around a 600 score. For conventional loans, it has a hard start at 620, but there are rate adjustments for every 20-point increments, so that the higher you get your score, the better rate you get, and the better terms you get for your loan. And I find that with most first-time home buyers, they wait until they're out with a realtor looking at homes to call us and say, hey, I want to buy a house. And when we pull credit, we find not always that they can't buy a house, because sometimes they can, but certainly that had we intersected them 6 months earlier, we could have dramatically increased their scores in a short time, gotten them better terms, gotten them better rates. So I think the best thing you can do in preparation for any purchase, whether you're a first-time home buyer or you're a subsequent home buyer, is call us up. Let's check the credit first. Let's see where we are. Many times we can implement just simple use policies, how to properly use your credit cards, and we can get your scores up very quickly. So I would say that the biggest point is establishing credit and getting a review of your credit if you already have established credit to see where you stand in that regard.
Yeah, and one good tip for you, you guys listening, you can go to annualcreditreport.com and request a free credit pull, free of cost. Typically now it's about $75 for
an actual credit report, yes.
So it's a good way to just get some insight onto where you actively are in the moment. But to go with that about the intersecting long before you are in the position where you're talking with a realtor and viewing houses, I think that it is a great idea for just to give us a call when you are first considering buying a house, because as he said, it can take months and months if your credit either hasn't been established or you've had issues in the past with credit. It does take some time for that to recover. And as he mentioned, you do get a better rate with a higher credit score, and it just helps a lot of the process along. So another big part of the loan process is the down payment. So why don't you talk a little bit about that?
I'll do that. I'll mention one more thing about credit because I find this to be the case. When my phone rings, if my conversation begins on the other end by someone saying, you know, I really messed up my credit and I don't even know if I can buy a house. 90% of the time, a person who feels that way is already where they can buy a house, they just did not know it. I tell people by way of encouragement, if you filed bankruptcy today, you walked away from all your debts, that's the worst credit impact that you can have. But if you did that, we can put you on a plan that within 2 years you can own a house. And that's not a very long time to fix a totally cratered credit situation. And so what we're talking about for the normal borrower who comes with us is not starting over from a bankruptcy, but we're starting from where you are. And we can very rapidly get you into a position where you can either buy a house with lower scores, or you can wait and we'll build the scores and you can buy that same house with a better rate 6 months from now, a year from now, or whenever the scores come up. In regard to down payment, that remains and always has been the largest barrier for anyone to get over in order to own a house. But within the past 10 to 12 years, all of the institutional loans, the Fannie Mae loans, Freddie Mac loans, the FHA loans, all of these have developed ways to assist borrowers with down payment. Some of that assistance is outright down payment assistance, where you can borrow your down payment from the same lender that's giving you the loan, where there are grants for many first-time home buyers. There are grants for emergency responders, and sometimes those fill the gap where people don't have a readily available source of down payment funds. But for all programs, they now allow for the down payment to come as a gift from a near relative. And a near relative is defined as anyone up to a first cousin in your family. It can also include, though, and we've had this happen a number of times, it can be from a godparent who is not a relative of yours, but who is a registered godparent with your church or wherever else you might have executed those things other than just informally. And so your down payment can be gifted. Other sources of down payment that people don't realize is that everyone can take what is known as a hardship withdrawal from their 401k at work, and that can be used as down payment. So solving the down payment issue used to be a much bigger concern. And had you asked me this question 15 years ago, I would have said the starting point is putting the down payment together. But because that's largely been taken care of by a number of available sources, we don't really have that much problem anymore. It's really the credit that we start with. And of course, we include what down payment will be needed so people can put those strategies together.
So, kind of moving along the process, like we said in the beginning, 35 years, and it has changed astronomically since then. Back when computers weren't storing any of our information and it was all done by hand.
We used to handwrite our application. Yeah. The great thing was that a whole loan application was about 7 documents.
Yeah.
And now it's like 50. So things have changed. I don't know that they've gotten better, but
well, yeah, it's a lot more to sign. But I bought my house with my wife back in December, and even having a mortgage broker as a father, I was just terrified. I thought it was going to be this massive mountain of just documents after documents, and I thought I was just going to get buried in the paperwork and not really understand what I was getting myself into. I mean, at the end of the day, I knew I was going to be paying something monthly, but I think a lot of people are just intimidated because it is one of, if not the biggest financial decision that an individual or a couple or a family will make. And one of the biggest things I realized through the process was it was oddly easy. Just, of course, I had help from a mortgage broker, and not everybody's blessed enough to have that as a father when looking into housing. But it really was. The paperwork was streamlined with the E-Sign Act of 2016, I believe. It could be wrong with the year, but everything's digitalized now, so the signing process was easy. I had to do income verification because I did work an hourly job as well as I was employed under my father, which requires 2 years of records, which is another thing with self-employed borrowers that we run into a lot. But it really was an easier process than I did imagine, and now I have friends that are looking into, buying their first houses, and they're in the same position I was. They were just scared. So what do you think, or what would be a piece of advice that you would give a first home buyer to just kind of ease the nerves of tackling such a massive financial commitment?
I think I have said this sentence probably with every first-time home buyer to assure them that what they're feeling, the kind of the intimidation, the kind of hesitation and nervousness. And I tell them this, if I had to come into your job today and do your job, I would have a million questions because I've never done it before. And so it's really natural that you would feel a bit intimidated by a process that is not very simple to do and involves a lot of complexities that you just do not encounter except when you're buying a house. And even for people who are buying their second home, they might have bought their first home 15 years ago. And it was a different world then. The process was different. And it's just the lack of familiarity, I think, that combined with the fact that it is almost universally for anyone buying a house, it is their single biggest financial transaction that they'll ever do in their life. And you might think, well, Jeff Bezos doesn't feel that way, but yes, he bought a $150 million house, and so that's probably the biggest single financial transaction he's ever done. And so everybody is in the same boat that you are. And I tell people that there's no such thing as a dumb question. That your questions are legitimate because you can't possibly know something that you've never experienced. And so we like to position ourselves as just, because of the expertise we've developed over the years, as we're a great source of information for you. And if you have a question, you are welcome to pick up the phone, call us, contact us by email. We'll answer the question because the more you know, the better off you will be able to be to make the decisions that work for you and your family.
So kind of moving on to how preferred, you already mentioned how you kind of started, but why have you stayed for 35 years? Because you've seen markets that are very, very good, and you have seen the absolute worst, such as, the 2008 crash that took out several parts of the world, let alone just the United States.
Right.
But
well, that's a good question, and I had quite a varied career prior to getting into the mortgage business. I was a chemist, I was a chemical engineer, I was a builder and developer, and I got into the mortgage business, and I didn't even think when I got into it that it was going to be something that I would do for 35 years. I actually thought that I would get it up and running and let somebody else do it and go back to building and developing. But a few years into this business, what I found is that the relational aspect of helping people at that particular junction in their life is just an extremely enjoyable experience. It's very rewarding personally to watch people's dreams come true and for them to establish their home for their current family or their future family, and to be a part of that process. It's very rewarding, and it is every day. I've had the opportunity to retire a few years ago, and I looked at everything over and over and over again, and the thing I couldn't get past is that why should I quit something that I enjoy doing every day? And the enjoyment is not in the process itself. The process gets pretty stale after 35 years. but it's interesting and it's rewarding because we get to be a part of someone else's life and someone else's dream and help make that become a reality. And that's why I get up every morning and come in.
Yeah, and watching this business kind of grow over the years, for a very long time, I just didn't understand it, didn't know it. But once, when I was a freshman in college, he just said, "Hey, come work for a summer, see if you like it." I think that was him trying to pin me down and, you know, get to where I am today. But I was spending my summers working with him, and I just fell in love with the approach that we could take with a borrower, because at the end of the day, it is very rewarding. These people are stressed out. These people have no clue what they're doing. And just to be a good source of information is one thing, but to see the finished product and to get to that finish line is very rewarding. And there have been many instances where people have called in with legal advice because they're in estate issues, or their lender is coming after them for something that's illegal and they're trying to manipulate them. And I've seen many cases where there's no financial gain, but just the strict reward of helping somebody out is really what drove me kind of through the doors and made me want to step into this company full time and eventually look into taking it over. Because I feel like if you work a job that you don't enjoy, you're not going to do it well, you're not going to want to do it. So that was a very big driving factor into, why I am now in the company and will eventually be taking it over.
Yeah.
But one of the things that I did want to talk about is, I think there's a misconception with my generation and with the people that I've talked to that are around my age, that we live in a world where we get everything instantly. If we want news, we go on our phone and it is just right there. If we want something, we can have it delivered to our front door, whether it be food, groceries, electronics, anything. Well, Amazon being the biggest company there is. We live in a society that is just adapted to this instantaneous reward or thing or material thing. But I've talked with several of my friends of, they want to look into a house and they want to be into a house at the end of the week, but that's just not that's not only what you not want to do, but it's also not how it can happen. Sometimes it takes up to 45 days from the start to all the verifications, all the paperwork, and then to the finished product. And I wanted to pick your brain. Why do you think it's important, especially for first home buyers, to really saturate themselves in the market and to understand in a slower process where it may take them 6 months to get into a house? Why do you think that's important for them to just take the time to not delay the process, but just slow things down?
To work through the process.
Yeah.
Well, I do recommend that. One of the biggest things that needs your attention and you need to become competent at and familiar with is, in the area that you're purchasing, how are you going to recognize what a good value is when you see it? How are you going to know that the house you're buying, for instance, is in a good school district? If you're planning on having children or you already have children, it's a huge consideration. How are you going to know if a neighborhood is generally improving itself and renovations and housing is getting better, or where it's being neglected and declining? And the only way that you can do that is to make yourself familiar with it. Now, that can be from various sources. Having a realtor on your side is a huge and highly recommended thing to do, because that's what they do all day long. They assess every property that is out there over every aspect of the property, and they can help you with the questions you have. What school district is it in? Well, is a brick house better than a house with vinyl siding? There are so many aspects to the house itself, not only to its location, but to is the house 3-bedroom and 1 bath, or is it 3 bedrooms and 2 baths? Does that really make a difference, or does it not? And when you go to resell, there are just multiple layers to all real estate decisions, and you just want to be an informed buyer. It doesn't take forever, and we've got great tools to do it with now online. You can go to Zillow and just screen out a dollar amount for housing this amount and less, it will show you everything within a 30-mile radius that you can buy. And you can go through the homes, and then one catches your attention, or it might look a certain way that you like, and so you see, well, where is this home, and what school district is it in, what's the price of this home compared to others, would it be okay for me to live in this other neighborhood where I can get more square footage for a little bit less, and then I'm only giving up this or that to be there rather than over here. And you just don't want to be making those decisions on the fly. You want to take your time with them. And again, we're not talking about a huge investment of time. 4 to 6 months is a long time to peruse the market if you look at it every day and you drive around to the particular homes that interest you and just see what they look like from the road. And pictures don't always tell the whole story. You need the physical perspective of seeing that. But I think that's why you should not feel pressured. And I think a lot of first-time home buyers feel like, well, if I don't get out there right now, there's not going to be any homes out there. And I would have bought that house, but it's already gone, it's already sold. I can assure you that the day you walk out ready to buy a house, there will be plenty of houses to be bought. You'll be in the mix, you'll be able to make bids, and you won't be left behind.
I think one of the biggest things is kind of what you said, you just don't want to jump the gun on it. And I got very lucky with the house that me and my wife did find, but what I find hilarious is that where we are, it's, it's coming up, but it's still a very, lackluster neighborhood. We don't have an HOA, we don't have gardens and this type of stuff, but the house itself was built in 1962. And a mile and a half down the road, you can have the same exact house and it is worth 1.1 million. Now,
Yep.
I was nowhere
Sure.
close to that valuation with my house, but it's a mile and a half difference.
Yep.
The same house built in the same time. Sure, this one may have renovations and other stuff, but the biggest thing is I fell victim to that. I thought, if I don't do this, then everything's going to be gone. I'm not going to get what I want, and it's just going to ruin the process. So
Right.
I do. And another thing with the process, the first house that I went and looked at, they had dolled up the pictures on Zillow, they had done all of these things, and it looked like this killer house and looked like it was going to be an amazing thing.
Right.
And then we got in the doors, he came with me.
Big disappointment.
It was just, they really did doll up the pictures, and, no offense to them, but that's just, I don't get why you do that.
I don't
Because
either.
people are
I
going to
would
see the
rather
house.
have
and-
someone be surprised that it's better than be surprised that it's worse.
Yeah, but you're going to find that, especially if you use sites like Zillow, people do doctor pictures. They won't edit the whole thing and make a fake house out of nothing, but they will.
Yeah, they just
hide
won't take pictures of the problem.
Yeah,
parts.
yeah. But, one of the other things that I did want to talk about is just some of the craziness of how we are here today and why there's 1,700 pages of regulations just for Fannie Mae and Freddie Mac. And I know it ties a lot into the 2008 crash, but what have you seen has become one of the biggest obstacles out of that with all the new regulatory things and all of the gray area that we deal with every time?
I will say this, that given whether I would want to have a regulation or not want to have a regulation, I'd always tend towards don't give me a regulation. But it kind of is not entirely true. The regulations that have been set for mortgage lending, if you understand them correctly, actually can be a really good safeguard for you yourself. For instance, how much house will a lender let you buy? Or the same question in a different form, how much of a house payment can you afford or they will let you get into? And the answer to that is regulations. Well, the regulations set what we call debt ratios, which means they do not want your house payment to exceed a certain percent of your income. Well, why is that a regulation? In this case, it's a good regulation because they've kept 75 years of statistics on defaulting loans. In other words, of borrowers who quit making their payments, and they look at that and they say, in a very forensic matter, what happened that made it where this person couldn't afford their house payment anymore. And their experience of that over the years has allowed them statistically to fine-tune the regulations in a manner that if the loan is made according to the guidelines, the debt-to-income guidelines, a person will never be in financial stress where they are in danger of losing their home, apart from a catastrophic event that you cannot control. And it's kind of an interesting thing. Fannie Mae and Freddie Mac, FHA, all of them publish their annual default rates. And it ranges anywhere from maybe a historic low of about 1.8% to a historic high of 3 to 4%. But within that default group, there is a percent of the people who default on their loans who had perfect credit when they applied, who had plenty of down payment when they applied, who made their payment for years and years, and you go, well, what happened? Well, what happened was a catastrophic event. The death of one of two people who were earning income. Divorces are sources of defaults. When you split a family and you divide the income, quite often that leads to a default. So all of those statistics let you know that what the lender will let you buy in terms of how much house you can buy, how much house payment you can take on, that the number one thing they don't want is to take back your house in foreclosure. Contrary to what people think, the last thing in the world a lender wants is a vacant house that's been foreclosed on that they have to resell, because it will only sell at 70 to 75% of what it's really worth, and the lender loses money. So the guidelines that are there can also be used as, I call them guardrails. They just keep you from going off the cliff. And in that respect, a lot of the regulations are good. The type of regulations that are very oppressive just have to do with the massive amount of paperwork that's required now to basically take what we used to cover on a single page and a single signed document, that now once you sign the document, it seems like the next document said, now did you really see this other document that you signed, and did you really understand that that's what it meant when you signed it, and you signed that one, and then you have another document that says, did you understand the other document that said, did you understand the other document that you said, and all of a sudden you've got 5 documents that basically say the same thing. Don't give you any more information, but it makes it look like this hugely complex issue, like, oh my gosh, I have to sign 5 pieces of paper for this one thing. Yeah. And again, those kind of redundancy, the attempt to say, okay, you assented to this, but are you sure you assented to this? Mm-hmm. It's that type thing. And then just the convolution of the process itself, and like there are required waiting periods. Mm-hmm. So, electronics, I mean, you can imagine how faster the mortgage process should be right now compared to 35 years ago. We had to handwrite applications. We got our credit reports over on a teletype machine. We had to type that physically into a typed up application after we had done the written application. Mm-hmm. We had to put all the documents together. We had to mail the whole loan package to the lender and wait for it to get there. And if you didn't mind spending a couple of $1,000s a month at UPS, you could get them there overnight. But basically, all of that has been eliminated. We do everything electronically, so it ought to be, well, why does it still take 30 to 45 days to close a house? And it's because, well, the Dodd-Frank provision said, well, somebody signed this document. We got to make sure they not only knew what they were signing, so we're going to give you 5 documents, but then we're going to wait 3 days and make sure that if they didn't really want to do what they said they wanted to do, they don't have to do it. And these mandatory waiting periods have actually added about 14 days to the process. Fortunately, the electronic system has given us back some of those days, but it's still, buying a home today is not much different than in 1989 when we started. Yeah. 30 to 45 days isn't going to happen instantly, and it's just a process. Yeah.
I think to kind of a perfect story that would kind of encompass why we get now buried under all of these documents was a story that he used to tell me growing up. He used to have a office here in Spartanburg and in Las Vegas, and you had about 40 loan originators under you at the time.
Yeah.
And one of the craziest stories of just that era of time leading up to the 2008 crash was the mermaid story.
Yeah, the mermaid story.
Yeah.
If ever there is a reason for the regulations that exist, it's the mermaid story. So, Hunter mentioned earlier that one of the difficult situations for anyone who is self-employed, because their income has to be averaged, their qualifying income has nothing to do with the gross receipts that they bring into their business, it's their net profit. And because no business owner wants to pay income taxes, the CPAs deduct everything that is possible to deduct, and that becomes their net income, and they're really glad about that because they don't have to pay a lot of taxes. But then they come to buy a house and they find out, oh my gosh, I took all these write-offs, I'm not showing enough income to buy the house that I know I can afford. So self-employed borrowers always have a problem. Well, there was kind of a recognition back in the 90s that, okay, self-employed borrowers do this, and so yeah, they can probably afford more house than what they show on their income taxes. So an early version of what came to be known as the stated income loan was that the self-employed borrower could submit their taxes, but in a reasonable addition to their qualifying income say, yes, this is what I reported for tax purposes, but hey, look at these write-offs. Some of them are just paper write-offs, and we could add that income back into their qualifying income. Well, that worked well, and they found out that that type of loan didn't have any greater default rate than a regular loan. So they said, well, why don't we just eliminate having to have the tax returns and just let the self-employed borrowers tell us what their real income is. And that was a true stated income loan, later became known as the liar loan, because, given the opportunity, human nature says, well, I'd like to have this bigger house than I would this smaller house, so why don't I just say I'm making more money? And sure enough, they made those loans, and for a good while, they didn't have a higher default rate either. And then some, brilliant idiot said, well, we're doing this for self-employed borrowers, and it hasn't made any difference in the default rate, so why don't we just let anybody state what their income is on a loan? And so they did. And that became the famous liar loan that brought the entire mortgage industry down and almost took the whole world down with it. In 2007 and 8, they started letting anybody who wanted a loan just say, hey, I make this much money, let me buy a house. And the result of that, the culmination of that, was in 2005 out of my Las Vegas office. My partner called me up and he said, well, you're not going to believe who I just made a loan to. I said, well, I probably wouldn't believe it, but who was it? He said, I just made a loan to a mermaid. And I said, well, Tim, that's really interesting. Well, tell me something. How much does a mermaid make? And he said, well, I don't know. And the joke was this woman was in the Cirque du Soleil production at the Bellagio Hotel, which was a water circus, a water show. And she was a mermaid, which I think meant that she, swam around in the tank, maybe for an hour each show, and that was her job. So I said to Tim, what does a mermaid make? And he said, well, I don't know. She applied for a no income loan because they went one step further from stated income, and they just said, well, don't even give us your income because we don't want you to lie. We know you can afford it if you say you can afford it. Well, the mermaid did one of these loans, so Tim had no idea how much money she made. I said, well, how much of a house did a mermaid buy? And he said, well, it was $900,000. I said, good grief, $900,000. And he said, yeah, and it was 100% loan. She didn't even have to put a down payment.
Goodness.
I said, Tim, you got to be kidding me. We got a mermaid who bought a $900,000 house with no money down and no income stated, no income on it. He said, yeah, and not only is it that, but it was bought as an investment property, a rental property. And I remember saying to Tim, you know, this is not going to end well. And I wish I had had the foresight to see the crash of '07 coming, but like everyone else, it caught me off guard too. But it certainly made sense in the aftermath of that. You know, there was a point in the build-up to all of that crash that I had begun to think, well, there's not going to be any place for a mortgage broker anymore, because what do you need a mortgage broker for? You just sign on the dotted line, you don't put your income in, you just say, hey, I'm Joe Smith, and I want to buy a $900,000 house with no money down, and what do you need a broker? So I really started looking around saying, well, if that happens, what am I going to do? But craziness is rewarded by crash, and that's what happened. And in the resetting of everything through the Dodd-Frank provisions and all of the safeguards that were put in, what actually happened is that the whole mortgage process became 3 or 4 times more cumbersome than it had ever been. The need for someone who is familiar with all the ins and outs of the regulations and the programs became highly valuable again. And so we sit here in a market where we bring a tremendous amount of value to a transaction. We're not just rubber stamping a signature anymore. And we actually help people navigate all of that world, answer all of the questions so that they can come to the decisions that are best for their family, and then they've got an advocate when we go into the system and actually go after the loan.
Yeah. So I think that just kind of completely adds up why we are in the position we are today, and it kind of shows why a broker platform really is viable nowadays. I mean, it's just this massive market for one, and then you have all the regulatory side of things, and we can just sit down with you, talk things through, explain things to you, and then, as he said, there isn't a stupid question. It is your money that you're putting on the line. We're not lending it. We don't see any of your questions as stupid. So we encourage you, if you have any general questions, please call in. And if you want us to talk about a specific situation or scenario, we do plan on doing a section on the 2007-2008 crash, just to kind of explain it through our eyes. And well, not my eyes, but how he saw that and how he made it through that. But we encourage you guys to just be interactive in the comments. Just leave whatever question you may have, and we can talk about it in later segments. But we are located in Greenville, South Carolina, the upstate, but we service all of South Carolina. So even if you're down in Columbia, we have a few LOs down there that would be able to help you out.
And we also reach into North Carolina and Georgia through a co-broker arrangement that we've had for years and years in those states.
But if you do want to call in, our office number is 864-235-9596. And if you would like to reach either of us by email, his is mark@thegreatestrates.com. It will be in the description below. And mine is just hunter@thegreatestrates.com as well. But we do really want to encourage any questions, any topics that you may want to hear about,